Hello everyone, welcome to WFW's Transport webinar series. It's a collection of 8 episodes where we're covering the key topics in the maritime, aviation and rail industries that we're facing at the moment. Today's webinar concludes the third in our maritime series. Before we get started, just a couple of housekeeping points. Please note that participant video and audio have been disabled. But if you do want to ask questions, there is a Q&A function at the bottom of the screen. So please do submit your questions and we will deal with those at the Q&A session at the end. Alternatively, you can contact the speakers at the end individually and they will answer your questions. And slides will be emailed following the event, so you will have them. And the webinar is being recorded. So you can ask for a recording afterwards as well, be sent around to everyone. So the first presentation today will look at maritime securitization. This is being presented by Jim Bell. Jim is a partner in our London Asset and Structured Finance Group, and he's also co-head of our aviation practice. And he will also be joined by George Macheras, a partner in our London Asset and Structured Finance Group. Following this, Will Vogel and Simon Ovenden will be discussing accessing the international capital markets. Will is a corporate M&A and capital markets partner based in our New York office, and Simon's also a capital markets partner, but he's based here in London. So over to you, Jim and George, and thanks very much.
Thank you, Lindsay. Okay. So just start by talking about what is securitization, because probably a lot of people will have heard of it, but maybe not know exactly what it is. Essentially, it's a financial product where you issue securities, so loans or notes off the back of a pool of assets. So you're not looking specifically or usually to a creditor's own sort of capabilities. Instead, you're looking to a sort of pool of assets as in the context of security. So the underlying assets are transformed into securities, hence the expression securitization. You may well have heard them called asset-backed securitizations or ABSs as well. What have been done in maritime and what can be done in maritime when it comes to securitization? And the most common really to date has been both performing and non-performing loan portfolio securitizations. But there is also the possibility of doing shipping lease portfolio securitizations. So that is another option there. When we talk about what securities are created, it really depends on who the investors are. So if you are looking at investors that are more sort of insurance companies, pension funds, other things like that, they may prefer bonds, but the bulk of the maritime securitizations to date have been done pursuant to loans, and that's because they've been held principally by banks rather than by other sorts of investors. So just here's a sort of a very simple securitization structure that I thought it would be helpful for us to walk through to explain. So at the bottom of the slide there, you've got the debtors. So effectively where you have, for this purpose, but let's talk about loans. So where you might have a portfolio of underlying loans where the lender is looking to securitize its exposure, then in that scenario you have a number of debtors, i.e. all of the borrowers under the various facilities, and then the originator, so the bank that holds all those assets, looks to then transfer those into an issuer vehicle, and then that issuer vehicle looks to either borrow debt or issue notes in order to supplement the purchase of those assets. Usually what happens is that the originator or seller is usually the junior investor in the securitization, so that effectively they get the equity position in what's left in the pool of assets. And so in there you've got the sort of junior investor piece, the senior investor piece. Obviously, as with any sort of financing, that could be sliced and diced in any number of tiers of debt as appropriate, but this is the sort of most common sort of standard format that you would expect to see. On the left there, you will see that it's got the idea of sort of orphan trust ownership. That isn't always the case, but is usually targeted to avoid potential contamination with originator insolvency risk, which I'll talk about a bit more shortly. On the right-hand side there, you've got the servicer. And so the servicer may, in certain instances, be appointed, a servicer might be appointed to run the function of the issuer, because the issuer vehicle will be an SPV, and so it won't have those capabilities, and so usually a third-party servicer will be appointed, and it's quite often that the originator is also appointed in that function as well. So that's the sort of very basic sort of format. Pass over to George now to talk about the goals.
Thank you, Jim. Hi, everyone. So we're going to look very briefly at what actually one is looking to achieve by undergoing a securitization structure. And I should say from the outset that actually these goals that we've set up here and the points we're making are not just bespoke to the maritime industry, but actually there is a bit of a commonality in goals across various sectors where securitization is prevalent. Although, as you will see in some cases, certain of these points and certain of these goals are a bit more emphasized in shipping. So as Jim said, you've got your loan or your bond proceeds, depending on how you structure it, which will be used to purchase the underlying assets. And how you purchase these underlying assets is that you transfer these assets to an orphan SPV, which means it's an SPV that is removed from the originator group, so it's not consolidated within the originator group, for the purposes of ring-fencing the assets, or segregating those assets and protect against the originator insolvency. So the net impact on that is the fact that the cash flows will be preserved, or should be preserved, in the event of an originator insolvency. Now, the reason why we put the true sale in quotation marks is actually because in some cases, less often than not, but in some cases, the originator, the SPV will actually be linked to the originator. So you will be outright owned by the originator, and that's when you achieve a synthetic or a credit-linked asset-backed securitization. And the benefit of the purpose of that is that you pass on originator credit risk, and you recharacterize your risk as from a title transfer to a loan or a bond which is secured by the underlying assets and by the underlying cash flows. So how you actually go about structuring that will depend on a number of things, including the security methods. And we've put in the slide here a reference to assignment or a declaration of trust, which depends on the jurisdiction involved, in the jurisdiction and the location of the underlying assets which are being secured. But actually, the benefit of the various security structures is that you can diversify and you can actually improve your credit rating. You can actually achieve better regulatory capital relief, or just actually better credit enhancement, which actually Jim will talk about in a bit more detail now.
Thank you, George. So just jumping on to sort of credit enhancements and what might be done in structuring a deal so that you get sort of credit benefits, and as George was discussing. So the first one there, so I've split between sort of internal and external credit enhancements. The first one there is subordination debt tranching, which if you remember from the former slide in the structure diagram, effectively that's just where you've got a senior and a junior portion, but of course that could be tiered in any number of tranches. And so the way that works is obviously the most junior of the classes suffers the first loss, and so that therefore strengthens the position of the senior class, and so that's how you might get some credit enhancement. Over collateralization is another common feature of securitizations. One of the particular things that you will see, particularly when it comes to non-performing loan portfolios, you might see an LTV of sort of 40 or 45%, depending upon asset values and what they think can be sort of generated from the non-performing loan portfolio. But contrast that with the sort of more usual 65% where they are performing. Excess spread. Now, the way that you structure a deal can be structured such that there's more monies being received by the issuer than are obliged to pay upstream to the creditors. And so in that scenario, there could be a surplus of cash that's being generated either to produce a reserve fund, but also could also be used simply as a buffer should there be any sort of underlying portfolio defaults. And sort of connected with that as well, one of the ways that you might generate a securitization is that you might generate that on a sort of pay-as-you-can basis, or by with sort of specific target repayment mechanics, or absolute target repayment mechanics, or indeed benches where you effectively have to achieve a certain pay down by a certain period. In terms of external sort of credit enhancements, there might obviously be a guarantee. So the usual position, as we sort of said at the start, is that this will be sort of non-recourse to the originator, but it could also be the case that the originator does in fact provide a guarantee. Similarly, we have seen in the past some ECA loans that have been through the structure, through a securitization, added directly, and so there might be some level of ECA support either through the structure, through the existing loan package, or alternatively where an ECA is willing to do that by supporting the whole securitization as a whole. There may also be an other form of guarantor, often where you are trying to achieve a specific credit rating for a class of debt, particularly where you might have split that into bonds and you might have sort of A, Bs and Cs. Then in that scenario, the A debt might be supported by a monoline insurer to ensure that it can achieve that sort of a AAA rating. Liquidity facility, again, this is really dependent upon who the investors are. For most investors, when it comes to maritime securitization, this won't be necessary. However, if you are looking to do a product where the investors are going to be insurance companies, pension funds, those sorts of alternative investors, then in that scenario, they usually absolutely require payments. And so where there is a delay in payment because of an underlying default, often they will require a liquidity facility as part of the structure in order to supplement those defaults to ensure that they are continually being paid come what may. Currency swaps and interest rate swaps. Now, obviously, under the relevant underlying loan package or lease package, these could be there can be any number of loans and leases, and they might be under different currencies or under sort of fixed or floating rates. And so, as a result, what you want to do is package them correctly together, and so you would need to put in place appropriate currency swaps and interest rate swaps to ensure that there was no sort of swap or interest rate risk in the transaction. Okay, so it's not always used to finance shipping loan portfolio purchases, although, as I have said, that is what it's most commonly being used for in maritime securitizations to date. It can also be used for as an effective way of reducing capital adequacy requirements and therefore providing cheaper financing. So effectively, the cost to the bank of supporting that financing will reduce, and therefore it can pass on some benefits by way of cheaper margins to the underlying borrowers. And we're currently looking at a securitization which does exactly that. Usually no recourse to the originator, as I said, and the principal reasoning for that is that some of the obvious advantage of a securitization is that there is diversification through the portfolios, because you have multiple credit lines as well as probably a lower LTV, and that usually creates the credit profile that you need, so that there doesn't need to be direct sort of recourse to the originator, although that can obviously be supplemented as required. As I said before, the originator is usually the servicer, or indeed directs the servicer, where it's a third-party servicer, and usually the holder of the junior loan or bonds, i.e. the equity portion. Where there is a servicer, the servicer will manage the portfolio in accordance with agreed standard of care and portfolio criteria. I would say that the portfolio criteria is, as you might expect, usually pretty hotly negotiated. The securitization expenses, and this is one that the banks who haven't done securitization before find unusual, but they will rank ahead of the senior creditors. And so the understanding for that is obviously that the only recourse is to the pool of assets, and so that pool of assets needs to be serviced correctly in order to ensure that the seniors and other lenders in the structure will be paid out. If plan on selling to international institutional investors, then usually better to structure as listed or private placement bonds. Investors may also require a debt credit rating, which can easily be achieved.
Thank you, Jim. So we just wanted to finish on a note with our observations as to how the securitization structure and the securitization tool has evolved in shipping over the last few years, and how actually it has been implemented in recent months. And Jim touched on the fact that there's obviously a clear interplay between securitization and the maritime loan portfolios and the disposals that have been happening in the last few years. So somewhat misleadingly, we've actually questioned whether you've got a choice between a decision to sell by way of an outright sale or to pursue a securitization, but actually how you make that decision as a lender, as an issuer, would really depend on a number of things. It could be regulatory pressures or other capital costs. It could be a somewhat tactical or commercial decision to outright exit shipping. It could be general exit, not just of shipping, but actually restructuring fatigue and exiting specific relationships. But whilst the two could be alternatives, we've actually seen situations where securitization has been implemented when it comes to outright sales. So actually, Jim and I were working a few months ago on a transaction where the Greek securitization law, which is quite a sophisticated piece of legislation, obviously applicable with Greece and Greek banks, and was originally legislating for, if you like, conventional vanilla securitizations, have now been used as a tool to circumvent and to get past various issues which come together, which come up in portfolio loans and portfolio loan trades. The obvious ones are jurisdictional issues. Shipping is, of course, a very cross-border industry, and how these impact on the structure. So an obvious example of that is that you can do away with borrower consent, at least in principle, when it comes to doing the transfers. So a securitization tool can actually be a very useful tool, as I said, not working in lieu of an outright sale of a portfolio of loans, but actually working as a supplement to that type of disposal. And for what it's for the benefit of foresight, with the benefit of foresight, we believe that this will actually be utilized even more in the coming months. Yes, thank you for your time, and we'll pass over to Simon and Will. Thank you.
Well, thank you everyone for joining. We're going to talk about accessing international capital markets. It's obviously a very big topic. We don't have a lot of time, but we wanted to touch on some of the sort of key aspects for those thinking about it. And really, I think here we're focusing on debut issuers, people who are new to the market rather than seasoned issuers, just talking about some of the things which would be of interest. And I think those fall into 3 buckets that we've set out here. We're going to talk a little bit about offering structures and trends we're seeing in the market. Talk about disclosure and some of the things that new entrants to the market will need to think about. And then, as importantly, I always think ongoing reporting. It's something that perhaps some issuers sort of take for granted. Yes, we know we'll have some continuing obligations if we issue debt or equity securities and we list them somewhere. But those ongoing reporting obligations continue to increase as time goes by. So we'll touch on that a little bit as well. Suffice to say that when we talk about the capital markets, we talk about debt, we talk about equity, we're talking about private and sort of public offerings. So there's a vast array of sort of tools in the toolbox, if you like. So we're not only talking about big ticket IPOs or $500 million bond issues. I think particularly in the debt market, we're seeing significant more activity where privately placed bonds are being used either as sort of part of a broader structuring that still involves loan financing. So perhaps at a mezzanine level, some subordinated debt, which is issued as notes and privately placed with one or a small group of investors. And it follows on that those bonds can be listed or unlisted. And even if they're listed, there are sort of a host of different venues that you can employ. From an EU regulated market, you list on the Irish Stock Exchange, London Stock Exchange, with obviously enhanced disclosure required under the prospectus regulation. But also, I won't call them listings of convenience, that sounds a little bit flippant, but there are other listing forums in Europe and obviously in the Channel Islands where disclosure is still required, but a sort of, shall we say, light touch disclosure. But you can still have the benefit of listing those securities, which is important for some investors and helps, for example, interest payments are able to be paid on a gross basis. I'm going to hand over to Will to talk about the US side of things, and he'll touch on IPOs and various alternatives and demystify Reg S and 144A if those terms are new to you.
Thank you, Simon. Good morning, good afternoon to everyone. So as Simon says, I'm in Watson Farley's New York office specializing in capital markets. So I'll be speaking, my comments will be primarily to the US capital markets. And in particular, I'll try to point out trends among shipping issuers. As Simon did, what I want to emphasize at the start here is flexibility in accessing the US capital markets. The US legal framework provides more flexibility than you might expect. A massive splashy New York IPO is not your only option and doesn't need to be the first step in going to the US capital markets. So on this slide, the first distinction is public versus private. And the decision here is whether to go through the steps necessary to access the public markets in the US, that's the NYSE or NASDAQ, or remain in the more limited market for US investors in private placements. Obviously, the fundamental trade-off in going public is obtaining greater liquidity. But as Simon said, you also obtain greater and ongoing regulatory burdens. That said, liquidity can be fairly deep in the private 144A debt market in particular. So that brings me to the subject of a so-called Reg S/144A offering. If we can go back to the prior slide, we're working our way down that list. This is the most common means of accessing the US private capital markets, particularly in shipping, which has an international investor base. So the jargon Reg S/144A just denotes an offering which is conducted both outside the US, that's the Reg S portion, and also to US investors at the same time. That's the 144A portion. These offerings are usually debt offerings, but they can be equity, especially where there's already some liquidity on a foreign listing. In the US, the universe of US investors available to you in these offerings is limited to QIBs. These are qualified institutional buyers. These are large institutional investors. I mentioned that the market for 144A securities is primarily in debt instruments, but equity can also be raised. There was in shipping some years back a pipeline of companies which did so, usually with the goal of listing in the US eventually. Dorian LPG, Scorpio Bulkers are a couple of examples which did successfully end up listing in the US. In these cases and others, often significantly more money is raised in the private markets prior to the IPO than in the IPO itself. So the main capital raising event is private placements, not the IPO. And so, this is an example of how you can use private placements as a lower commitment, sort of step-by-step approach toward a New York listing, and not necessarily as an alternative to eventually going public. Turning to the public markets, the list of items under IPO and alternatives. Obviously, an IPO is a traditional way to access the public markets. By IPO, I mean a public offering of equity, usually, although it can be debt, combined with a concurrent initial stock exchange listing. Now, the timing of an IPO is a challenge that I want to highlight, and is perhaps the first hurdle that comes to mind when people think about the difficulty of an IPO. The timing, and this is true especially if a large amount of capital is being raised. By timing, I mean not just the lead time, but the need to go through a relatively lengthy regulatory review process with the SEC, the timing of which is not entirely within an issuer's control. And then at the end of that process, you have to hit a market window for your capital raise. So clearly this is more of a challenge in unsteady markets. And so companies have pursued alternatives to address this issue, and some of these alternatives are listed on this slide. These alternatives to an IPO are not yet the norm, but they are of increased interest, especially given recent market volatility in shipping and everywhere. So let me make a couple of observations before ticking through these. Each of these alternatives to an IPO addresses the IPO timing challenge I mentioned in a different way, but they all have the feature of separating the capital raising step from the going public step, so that those two, raising capital and going public, aren't done concurrently. And you can see that the option that I mentioned of raising meaningful amounts of capital pre-IPO in Reg S 144A offerings in the private markets is another way of solving this problem. With regard to these alternatives, another general comment is that a challenge that attends many of these alternatives is achieving sufficient liquidity in your shares after the exchange listing. And this is related to a well-known, much discussed problem facing already publicly listed shipping companies, namely that a lack of sufficient liquidity in their trading markets is perceived as affecting their market valuation and their ability to attract institutional investors and raise additional capital. So let me run through these alternatives briefly. Double listing. This refers to a company with a foreign listing that adds a secondary US listing. This is often the obtaining of the US listing, can be combined with a capital raise, but doesn't need to be. Torm, Flex LNG are recent shipping examples that did so. A double listing is relatively easy. You have to already have the foreign listing, but it's easy in terms of legal formalities. It's quick. It's much less expensive than an IPO. However, until they do conduct a capital raise after the New York listing, companies have found limited shareholder depth and liquidity in the US. Next, direct listings. These are a novelty, a recent novelty. This is the model that Spotify used to go public. This is a direct listing is a listing of a previously private company without a foreign listing, without any capital raise. And these have been enabled by recent rule changes at both the NYSE and NASDAQ. The appeal of this alternative, particularly in volatile markets, is the ability to establish the listing and then raise capital later at a time of your choosing. There's also a sense that existing shareholders who wish to sell on the first day of the listing can obtain a better price than through an IPO. So those are the benefits. Speed and expense are not really benefits of this alternative. At least currently, a direct listing can be as expensive and require as much lead time as an IPO. And there are some significant hurdles, both legal and commercial, around establishing the valuation of shares, establishing a trading price post-listing, and creating market demand. SPACs. These are special purpose acquisition companies. A SPAC raises cash in an IPO with no identified purpose, and except to finance a merger or acquisition within a set period of time. In shipping, there's been a mixed record of success for SPACs that at the time of their IPO are focused on a shipping acquisition. But there's currently and for the last year or so, a real resurgence of SPACs that have IPO'd and are looking to put their capital to use. So here I'm speaking primarily about, for a private company, acquisition by a SPAC as a path to the public markets that avoids an IPO for that private company. Relative to an IPO, going public through a SPAC acquisition is somewhat faster and may provide more certainty on pricing for the private target company. However, one should be aware there are still public disclosures and requirements for audited financial statements that are similar to an IPO. And there is still market and deal risk that beyond what's present in any M&A transaction, inherent in the structure of a SPAC, because the SPAC shareholders retain the right to withdraw their capital if they don't like the acquisition deal. So you have to market the acquisition once announced to the SPAC shareholders. There are also some complicated economic and governance issues, particular to SPACs, dealing with the interest held by the sponsor of a SPAC. Merger and acquisition. A SPAC is a variation of this. Here, I'm just speaking generally about the acquisition of a privately held fleet by a publicly listed company. This is a direct way into the public markets, acquisition by an already public company. These are so-called ships for shares transactions. And as a path to go public for a private company and obtain liquidity for investors in a private company, this has the greatest speed of execution and deal certainty. And I'll point out that the ability to use shares as currency for acquisitions, particularly at a low point in the cycle, is something we've seen that is a significant benefit to a public company. And we've seen a number of these transactions in recent years, often primarily or entirely share-based. So to sum up, while shipping IPOs have been few and far between in recent years, some of these alternatives have emerged as viable. And I'll just point out that these examples highlight the possibility of combining access to the US capital market side by side with the international capital markets, as with Reg S 144A private placements or double listings. So moving to the next slide, thank you, offering structures and trends. I'll be brief here. The options here are primarily available to either private or public companies. But what I want to emphasize in this summary is, again, the flexibility available within the legal framework. So I spoke of the lengthy regulatory process for an IPO, but once public, some significantly greater speed to market is available. And in volatile markets, again, shipping issuers have made use of the offerings on this slide for that reason. Overnight offerings, the first bullet here, I mean, it's in the name. The speed to market is the appeal. You can launch and price an offering in an evening or literally overnight, and take advantage of brief market windows. Hybrid public/private offerings combine the speed of a public overnight offering with the sort of more highly negotiated structure of a private offering, but you're providing registered freely tradable shares. Under ATM offerings, buybacks, and tender offers, what we're speaking about here with ATMs and buybacks is the ability to sell or buy at market prices for a public issuer on an ongoing basis. And for tender offers, it's repurchasing large blocks of shares by an issuer. And what I'm highlighting here is the ability of a public issuer to reconfigure their capital structure to some extent based on their view of the valuation of their shares. Structured products, what I'm thinking of here that we've seen in shipping are equity-related convertible instruments warrants, rights, preferred stock, and convertible notes that let you create tailored transactions to even a small set of investors. So there's that flexibility in deal structure. And convertible debt is obviously one of these. There's a deep market for convertible debt in the US, which some shipping companies have recently accessed. Again, this is appealing at a low moment in the cycle. And I know Simon may want to address convertible debt as well.
Yes, I mean, not much to add to what you've said, Will, other than it is a useful instrument. I have worked on some convertibles that are called go public, where at the time the debt is issued, the underlying shares are private, but it's another method to allow investors to access something that's convertible into what will ultimately become publicly listed shares. Just another thing in our toolbox. Those are structures. In terms of trends, it probably would be remiss of us not to mention green bonds and sustainability-linked bonds. They are very much a hot topic across all industry sectors, including maritime. And I think that we've seen a couple of green bonds from MYK and TK and some other issuers which have hit the market. It's quite clear to me that investors have and I'm sure many of you are listening in today, bankers and investors, have different guidelines yourself as to what you perceive to be a green bond, what you perceive to be a sustainability-linked bond, how you address issues like greenwashing, and whether there is a place for maritime to access this rapidly growing market. I think there is. Be interesting to sort of see if other people have views on that. I'm just mindful of time, so just moving on very quickly. I talked a little bit earlier about disclosure requirements, and they do differ depending on where you might seek to list your securities. If you're listing on an EU regulated market, you will be subject to the prospectus regulation, which will mean you need to produce a prospectus of reasonable content, which is an exercise that you need to be mindful of if you're accessing the markets for the first time. It will involve a diligence exercise. Underwriters will want to understand your business, and you'll need to consider what disclosure is appropriate given the requirements of the prospectus regulation. You're also going to give reps and warranties to underwriters. And those are quite extensive these days, covering not only have you got the capacity and authority to issue the bonds, but obviously touching on sanctions, bribery, money laundering issues. Those are very important issues these days for underwriters to get sufficient comfort from issuers of securities. So those are things to bear in mind. As I said earlier, listing on some other stock exchanges allows investors to purchase listed securities, and that is sufficient for their purposes, and the disclosure regime is not quite as onerous as you would find under the prospectus regulation. In the US, sort of obviously some sort of consistent threads, if you like, in terms of disclosure and approach, but I'll let Will touch on those.
Yeah, again, mindful of time, the structure is similar in the US with extensive disclosure, underwriter due diligence to support the underwriter's task, and obviously audit participation with the audited financials. I'll just point out, without going into detail, that obviously there's much more flexibility on these requirements in a private offering as opposed to a public offering. I think perhaps we can move on to the next slide, which has to do with ongoing reporting obligations after the initial offering that takes one public. So this is about public companies. Again, I won't go into detail here except to note, obviously there is an ongoing obligation to do periodic reporting and be reviewed by the securities regulator in the US, the SEC, and there's ongoing accounting audit requirements. related party disclosure is a focus, and that gets to ESG and the G in ESG. The point I'll make, perhaps particular to the US, is that the social and political goals of ESG or disclosure around climate change are general. They're not sort of specific mandates at this time to make any of these disclosures, but rather they're driven by commercial considerations, demands of the market. But obviously that is a fluid landscape. Simon, would you like to speak here?
So in terms of the EU position, obviously similar reporting obligations under Transparency Directive. Issuers also need to be mindful of their obligations under the Market Abuse Regulation, which sets out the whole infrastructure for disclosing inside information where necessary. And that is something which obviously issuers should take detailed advice from their legal counsel on, because it's a very important obligation that you assume once your securities are traded on regulated markets, but also on MTFs as well. And then the last point there, the non-financial reporting directive. Again, what we're seeing is enhanced reporting obligations imposed under EU legislation. The non-financial reporting directive requires issuers to talk about a whole host of things relating to social policies, environmental impact, and so on. And that's going to be further enhanced when the EU taxonomy regulation comes into effect in 2022. So, there are a host of reporting obligations that get put into place when you are a listed issuer, and it's important that companies obviously understand their obligations under those various bits of legislation. So I think that brings us to the end of our session. So I think perhaps I can hand back to the chairperson just for Q&A.
Thanks very much, Simon. Thanks, and Will. Jim and George, I don't know if you want to join us as well. So we've got a bit of time, I think, left for a couple of questions, and a few questions have come in. So I'll start with one that came in for you, Simon. You talked about ESG and green bonds. Is this really realistic for maritime issuers to play in this space?
I think it's a very good question. And I think, as I said earlier, I do think that investors do have their own views on whether or not a particular issuer meets the criteria for their own investment strategy. Some people will say, how can anybody in the maritime industry possibly do a green bond? The nature of your business means that you are a pollutant. But there are others, I think, who will say, well, if the use of proceeds is intended to mitigate the impact on the environment, that's a good thing. I think where the interesting debate lies is perhaps more whether sustainability-linked bonds will become more popular because they look holistically at the overall impact of the issue, and not just the use of proceeds, which is the focus obviously for a green bond. What do you do with the proceeds of this bond? I think with sustainability-linked bonds, which if you look at the new ICMA guidelines, will require sort of KPIs and specific targets, I think investors will be able to command a greater understanding of the whole business of the issuer, which enables them perhaps to make a more informed decision about whether or not this bond is really a positive sort of attempt to mitigate impact on environment and to lead to a more sustainable sort of future. So but it's a very good question, and I think it is a hot topic at the moment.
Yeah. So that's similar to the transition bonds that we're starting to read about, I suppose, Simon, that it's transitioning to something which is greener, cleaner, more sustainable generally.
Yes, I think that's right. And there are a whole host of different governmental bodies and other industry bodies that are setting their own parameters, what they regard as sustainable finance. I think that the ICMA guidelines are extremely helpful and set a useful industry benchmark. There's also going to be the impact of the EU taxonomy regulation as well, which is sort of coming down the track. But I think it's an interesting area, but I see no reason why issuers in the maritime space should not look at it with their investment banking advisors to see whether there isn't perhaps an opportunity for them there.
Thank you. Jim, there's one here for you. Are investors in securitizations looking at the assets or the cash flow primarily?
Thanks, Lindsay. It really depends on the transaction. I think for the most part, people are looking at the cash flows for the purposes of the securitization and then looking to the assets purely as security. But this question probably relates more to perhaps some of these non-performing loan securitizations, where as part of the structure you are factoring in sort of enforcement in order to determine whether or not in order to sort of source alternative cash flows to repay the borrowing under the securitization. And so it's a mix of both, but usually it's separate.
Yeah. And there's a follow-on question that somebody's asked Jim or George. What are the most common jurisdictions that are favoured for the issue of the SPVs that you've seen in ABS, shipping ABS transactions?
Shall I take this one, George? So usually it's the sort of, people tend to push towards the more familiar jurisdictions for securitizations rather than perhaps the more familiar shipping jurisdictions. So principally sort of the Cayman Islands, some Ireland is also a good alternative, but we have of course done in the Marshall Islands and other jurisdictions as well. So, but the usual positioning, because they are effectively able to deal better with sort of non-consolidation aspects, is to look at those that are sort of follow English law principles. And so Cayman Islands and Ireland has been a sort of an often choice jurisdiction.
Thank you. Will, there's one for you here. You talked about ESG and, sorry, that was on our assignment. Could you speak towards the trend towards the direct listings, and have you seen that in shipping at all?
Well, yeah, that's been spoken of as a trend in shipping. The issue to be addressed, I touched on in my remarks, which was establishing a trading market in the absence of a capital raise. And clearly that's not an issue for a hot tech company like Spotify, which has strong brand awareness. But perhaps the direct listing structure is more of a challenge for, or not well suited for, a relatively small, newly formed shipping company, which is the look of the companies that have traditionally gone public as shipping issuers in New York in the past. Strong market awareness is important to establish a trading market in the absence of the underwritten IPO capital raise. So, I mean, Castor Maritime is perhaps a counterexample in shipping. They were actually a single vessel company. They had one older bulker at the time of their direct listing. Diamond S and Navios Containers are spoken of as direct listing examples in shipping, which are more prominent. But the thing to realize about those cases is that those were formed as spin-offs of already public companies. And there are significant legal differences between a spin-off and the listing of a purely private company. Obviously, for a spin-off, the investor base is already present. So, Castor notwithstanding, I guess what I'd say is direct listings seem unlikely to be a common path for shipping companies in the form we've seen them IPO. And if you want to use this path, a shipping company is going to have to look different at the time of its IPO. It's going to have to tell a different story, I would expect.
Thank you. I think we've probably just got time for one more question before we wrap up. So, Jim, this maybe is one for you or for George. I've heard from securitization desks at banks that shipping is too volatile compared to airlines. Have you also heard such feedback?
Maybe I'll take this one. I think, well, given that I do a lot of work in the aviation industry as well, I mean, right now, that might be a funny question given the sort of current volatility in the aviation market. But yes, I think traditionally there have been a lot more securitizations in the aviation market, certainly. But there still have been plenty of shipping securitizations, and it is still possible to structure these. I think the difference is that you just have to get comfortable with the usual economics of shipping deals. So instead of looking at sort of 85% LTV, you're looking at 65% LTV and other metrics to make sure that it all works for the purposes of the securitization.
Thanks.
I agree with that, and I would just to add to that going back to the point that Jim and I made during our presentation, that you can use securitization structures when you're not as an alternative to other similar structures that you're trying to implement, such as an outright sale of a portfolio trade of a maritime loan portfolio, but actually as a supplement. So these pieces of legislation and these structures can still prove quite useful. In fact, actually, I would say they can be even more useful in a volatile industry such as shipping compared to other sectors. So.
And I suppose you have the possibility as well for, to make sure that your portfolio is very diversified, that you have a good mix of assets, that you have age ranges, ranges of the different owners. So I think that the ability to have quite a varied portfolio should be there with most loan books that you're securitizing.
Exactly. And how most of those loan portfolios are formed anyway.
And I think the point you made earlier, George, about the ability of securitization to get around some of those consent issues, I think we've actually seen that in practice, haven't we? So I think that's also interesting.
Exactly, it will work and it will work to a point. Obviously, it will work in relation to the jurisdiction, the primary jurisdiction. So with the Greek securitization law, you would expect the Greek court to respect this type of override of contractual hurdles. How this will be respected in other jurisdictions, we have no reason to believe that it shouldn't, but obviously due diligence would need to be undertaken.
I'm conscious of people's time and people's diaries, and we do have a few more questions that have come in, but what I propose is that we respond directly to those, and we know who's asked them, so we'll get back to you directly with those questions. So that probably leaves me just to thank all of our speakers today. Thank you very much, and thank you to you, the audience, for joining us today. I've got a few housekeeping things that I have to run through, otherwise I get told off by our events team. So shortly you'll be receiving an email with feedback, so please do feed in that. So it's really great to get your feedback. If you dialed in today by telephone and you want to receive the slide pack, please do email events@wfw.com, and that will make sure that you get the slide pack. And in case you missed the first 2 episodes in our Maritime series, they'll be available on Netflix soon. No, we'll email you out some of the recordings of those, that they'll be available later, early next month. And then we have 2 more sessions of our transportation webinar series left to run, and they're both on the aviation side of things. So if you're interested in those, please do email the events team. So hopefully the next time we do this, it will be in person in 2021. But if not, we didn't speak before. Very best wishes for the Christmas season from me. But thanks everyone for joining. Thank you very much.